All right, guys, good morning. So, what do you do if there is a stock market crash or correction like we've seen in the early 2000s when this came down multiple years? We saw in 2007, 2008 when this crashed as well. We saw during COVID, little crash right here, the EMAs held this up. So, what happens if we do enter a recession or a stock market crash in 2025? Well, I'm going to tell you one of the options that we all have access to and something that I recently just did. But I want to just go back and I want to tell you guys why I believe there will be a correction at some point in 2025, very soon, actually. I'm thinking more in the next several months. If you just look at the negative divergence that has been forming on a 3-month time frame, the S&P 500, this is the SPY, has been going up consistently, right? We have been in a massive bull market since basically 2010, right? You've been making money. But as we've been going up, the RSI has been making lower highs. What does this mean? This means negative divergence, and it's happening multiple times. So you can see right here, this is lower than this, right? This happened over here in a market crash. The crazy thing is people that held on. Imagine we were back in 2000 and they're like, okay, we're about to retire. Maybe we're in our late 40s, we're in our 50s, or even 60s. People that were holding on in 2000 and 2001, they lost a lot of money. I think it crashed over 50%. And then they kept holding on and it came back up and now they broke even, right? So we go from 2000 to 2007. They finally broke even because they had to hold through. And then what happens? The market crashes again. Guys, it took people that were trying to retire in 2000, 2001, whatever age they were, it took them basically 13 years to break even because it dipped, it came back up, and it crashed again, it came back up, right? This is the problem that I feel like we're about to face, honestly. I do think a recession is coming. I think people are not expecting it. Everyone's super bullish, and you just look at the world right now. Plus, you look at the charts and you look at this negative divergence that's forming on a 3-month time frame. So what can you do? And this is what I would recommend. If you are over 40 years old, over 45, over 50, in your 60s, you have done well. You've made money. You've traded. You've done whatever you've done to earn your portfolio to grow in value, right? Especially if you were starting down here and now you're up here. The SPY has hit new all-time highs and it's just climbing. But that doesn't mean it's going to climb forever. So what I just did for a client yesterday is I am helping her protect her money, some of her money that she has in an IRA. So this really is for people that have money in the bank. If you have an IRA or an old 401k, basically any money just in the stock market or sitting on the sidelines, you can choose to protect it with something called an index annuity. So this is what we're doing for her. This is an example real quick. What we're going to do is roll over 400,000 for her. Okay. She is 58 years old. Now, Athene, amazing company. I use this company for a lot of my clients. It's called Athene Performance Elite 10. So what does this mean? This means that $400,000 is going to be protected. No matter what the stock market does, we're going to lock in the 400,000 with a 0% floor. But it also means that if the market does great over the next 10, 15, 20 years, which it should come back, she's going to earn interest, right? You can see the annual assumed earnings rate would be right here. Now it could do much higher. This is just for illustration purposes. This is also the most recent 10-year period. Okay. So we roll over 400,000. What Athene is offering right now, if you're in the state of California, they're offering a 13% bonus on any money rolled in. Now, California is 13%. Other states are offering 16 to 18%, depending on what state you're in. So Athene is a great company. They've been around for over 100 years. Really good assets, low liabilities, just a solid company when you're looking at index annuities. Okay. So you can see right here, day one that she rolls over the 400,000, they're going to credit $52,000 into her account. You can see her accumulated value based off a 3.97% return the first year. We turn 400,000 into 469,000 year one. She has a cash surrender value. That means the money she can actually access in the early years. And she has a death benefit in case something were to happen to her. After 10 years, guys, we turn about 400,000 into over $1 million, okay, in a safe way with no risk. So you can see there's some zeros here. What this is illustrating is basically a down year. in the market. So you can see 0% right here would be credited to her account. And you can see that the accumulated value has stayed the same, 605,000, 605,000. So when the stock market's down, the cool thing about index annuities is you don't lose any money. But when the stock market goes up, you're making money. There is really no risk. Another thing about annuities is there's no fees. Okay. So a lot of you that invest in ETFs, mutual funds, if you have these IRAs, or even just money sitting in the bank, these ETFs and IRAs, these mutual funds, they're charging you a fee. Okay. If any of you have a financial advisor managing your money, they're also charging you a management fee. Okay. Usually 1% to 2%, sometimes 3%. I've seen 3% before. And no matter what the market does, they're still going to charge that 1%, 2%, 3%. So index annuities have no fees at all. So again, this is something that we just submitted yesterday. She's fired up about it. She also believes that there is going to be a correction. And the question is, how much of your money do you want protected, right? If I am right, and if the market corrects, and let's say in 3 years we're having this conversation, would you be happy to leave all of your money in the stock market, or would you have been happy to protect some of your nest egg into something like an index annuity? Now, there's all different kinds. The one I'm showing you is with Athene. There's also other companies, there's other products, there's lesser surrender periods, there's other ones with different bonuses, there's income ones. This is an accumulation one that we just did for this lady right here, and it's going to be amazing. We protected her retirement. It's going to grow over the next 10 to 15 years with the market, and then she can access it whenever she wants to. And then, of course, when you're in your 70s, we have RMD. So this is required minimum distributions. So what that means is basically you have to take money out of any IRAs, 401ks, annuities, because why? The government wants their taxes. So we start taking money out of this plan. You can see her accumulated value continues to grow with the market. Even if the market goes down, she will not lose any money. Okay. It's funny. I watched this video. I don't know if you guys know who Shaquille O'Neal is. He used to play on the Lakers, pretty good basketball player, but he has all these videos going around. It's like, if there's one piece of financial advice you could give to someone, what would it be? He said one word: annuity. So Shaq is really big on annuities. Again, it's a very great tool to use to be a part of your financial portfolio. I'm not saying you should move all of your money into an index annuity, but whatever you want to keep safe and you don't want to lose, an index annuity could be a great idea. Guys, if you're interested in this, make sure you send me a message or send me an email. I'll put it in the description. We could meet over Zoom or a phone call, and I can run an illustration for you and your family, and we can walk through it and see if this might be a good idea for you guys. With that, appreciate you being here. Hope you have a great week.